In this video, we will be going through a brief introduction of what bid and ask price in the market are, and the different types of market orders out there that you can use to buy and sell shares in the market effectively. This will be covered for both the perspective of investing and trading. But before we go through the different types of market orders, we first need to understand how market pricing works. And that is the bid price, ask price, and the market price. Alright, let's say that we want to buy a particular stock that is valued at $10 right now. Now we have the market participants in the market being split into two camps, the buyer and the seller. The buyers will bid with a lower price than the market price, and the seller likewise will ask for a higher price than the market price. Both sides want to gain, so no one is actually willing to trade at the market price itself. Then how does the market price comes about? It is taken from the midpoint of the highest bid price and the lowest ask price. And therefore, this difference between the bid and ask price, we call it the bid-ask spread. In this particular case, the stock has a bid-ask spread of 20 cents. And here comes the supply and demand. If there are more buyers than sellers, we will have more demand, and some buyers will be impatient and just buy up the ask price. And this therefore causes the market price of the stock to rise. And likewise, on the opposite side, if we have more sellers than buyers, supply now exceeds demand, and some sellers will be impatient and sell down to the bid price, dragging down the market price along with it. Now at this point, I would like to sidetrack a bit and bring in the topic of volume. Volume is the number of shares that have been traded on that particular day. So a stock with high volume means that it has a high number of market participants wanting to buy and sell. Consequently, we can see that these stocks have a narrower bid-ask spread. In this case, it's only about 2 cents. And as for low volume stocks, the bid-ask spread is rather wide. In this case, it is $2. And it is often hard to get your orders filled in at a good price, which is why when we are trading, we tend to avoid low volume stock, even though the market price for these two stocks are both stated at $10. Now, after going through so much, let us now talk about how to actually buy and sell shares in the market. There are three main types of orders you can use to execute your trades. The first one being market order, second one stop order, and lastly the limit order. Each of them have different function. A market order is executed immediately at the current market price, and it is split into the buy market and the sell market. And as for the stop order is triggered when the stock price moves past a particular point. When the stock price reaches this point, your stop order will be converted to a market order and then executed immediately at the market price. Once it reaches the particular price point, it will now behave like the market order that we have went through previously. And likewise, stop order is being split into the buy stop or the sell stop. So lastly, we have the limit order. The limit order is triggered and executed when the price is at the specified price or better. So likewise, we will have the buy limit and the sell limit order. Okay, I know all this may sound confusing to you right now, so let us look at the simplest order first, and that is the market order. So now, let's say that we want to buy the stock at $10, and we submit a buy market order. What will happen is that it will trigger immediately, and we will buy from whoever out there that is willing to sell at the lowest price. And for this case, it is $10.01. So the opposite is also true. If we want to sell at $10 and we submit a sell market order, then we will sell to whoever that is willing to buy from us at the highest price, which is $9.99. So you can see that by using a market order, you are guaranteed to get filled on your order. But the downside is that you don't really get to control the price at which you buy or sell. So this is a huge downside of the market order, and because of this, we almost never use this type of order at all. What do I mean by that? Now imagine that you are about to buy at $10 and you submit a market order. But for a split second, just before you submit, a big order from some institution came in and took out all the ask. What will happen to you? Your order will still go through at whatever the ask price is now. And this is very unfavorable for you because you will now be buying at $15 instead of your intended $10. So the same thing could happen on the sell side as well. Although these are rare cases, but such things do happen in real life. And I'm sure that you do not want to be the unlucky fella that sold your shares at $10 using a sell market order when the actual worth of those shares are $60 over. So this is a huge loss that could be easily avoided if you change your order to another type. Alright, so the market order is not for us. What next? Stop order? For the stop order to work, we need to specify a price. For example, if I want to buy at $10, so I'll set a buy stop at $10. And when the market price reaches $10, which is right now, my buy stop will be converted to a buy market. And once again, I'll be buying at the lowest ask price available, which is $10.01. So you can see that it still does not solve the flaw of a market order. But the stop orders allows me to wait at the sideline for prices to reach a specific level before entering. For example, I can set a buy stop order at $10.05 this time. And at $10, my buy stop order will not be triggered. And so I have to wait for prices to slowly move up. And I wait, and I wait, and I wait. Until now, when the market price is at $10.05, will my buy stop order be triggered and converted to a buy market order? And likewise, this time, it will be triggered and I'll be buying at $10.06, the lowest ask price available. So one thing you cannot do for this case right now is to set a buy stop at $10 because that does not make sense at all. So in summary, stop order also has a guaranteed execution on the condition that your price point is reached. And since it will be converted to a market order for execution, there is once again no guaranteed price. This type of order is mostly used when we are trading, and we will talk more about that shortly. Lastly, we have the limit order. For this order, you have to specify a price, and it will only be executed when the price is in your favor. Let's say that you set a buy limit at $10.05. What you are telling the system is that I only want to buy at $10.05 or cheaper. Make sense? We only want favorable prices. So what will happen when the market price is at $10? The system will automatically buy for you at the cheapest available price, which is $10.01. Now let's say that you set a buy limit at $10 this time. Will you get filled at $10.01? No, because you have stated $10 to be your limit, and you will only be filled if there is some seller willing to let go at $10. And lastly, if you set a buy limit at $9.90, what will happen? You have to wait for the prices to go down to $9.90 from $10. So what about the sell side? If you set a sell limit at $9.90, what you are now saying is that $9.90 is the cheapest or the lowest price that you are willing to go. In other words, sell when prices are $9.90 or higher. So when the market price is at $10, you will now be selling to the highest bidder with a price of $9.99 in this case. So your order will be filled. Likewise, if you now set a sell limit at $10 instead, you might have to wait for some willing takers at $10 before you get filled on your sell order. And if you set a sell limit at $10.05, you have to wait for prices to go up to $10.05 before your shares are sold. So very clearly, you can see that there is no guaranteed execution for limit orders, but your prices are guaranteed. For investing, we are almost always going to be using limit orders to buy and sell. And to overcome the small downside of unguaranteed execution, you can just keep shifting your prices down or up until it gets filled. Alright, so that's about investing. What about trading? Trading requires a precise entry point, a take profit target, and finally a stop loss level. We will need different types of orders to fulfill each of these functions. First of all, let us talk about the entry point. Let's say we are using a strategy that tells us to trade long whenever we see a bounce off the moving average support that was previously tested. So at this dip to the moving average right here, we see that it has been previously tested before, and we will be preparing to enter our trade. We think to ourselves that it will bounce off again and go into the next impulsive wave higher. But that is just what we think. To have a high probability of being right, we want to see prices being able to make a move higher and break the previous day high. So can you think of the order to use at this situation? Pause here and practice what you have learned about the different market orders and have an answer for yourself before moving on. Okay, so we want prices to reach higher before we enter. The most suitable order at this point is the buy stop order. So we can place a buy stop order at $190 above the high of this bullish pin bar, which is at $189. Now remember that the stop order will be converted to a market order once prices reach the high of $190. And remember the inherent risk about the market order. So to overcome this risk, we are going to add another order here. and that is the limit order. For the limit order, you can set it a few cents above the stop order in order to give some leeway. But I prefer to just let it have the same price as a stop order for simplicity. Now when these two orders are combined together, what is happening is that we will only buy when prices reach our target high of $190, but we will not enter at any price. The maximum that we are willing to pay for this trade is also at $190, which is the price of the limit order. Next, let us talk about our stop loss first. The stop loss is in place to ensure that we cut our losses at a certain point so that we do not lose more than we intended to. So with this in mind, can you think of a suitable order to use? For stop loss, we will be using a stop order. And in the case of a long trade, we will be using a sell stop order. So the low of this candle is at $179. And therefore, we will be placing our stop loss below this price at 177, just for example. With this order in place, what is going to happen? Basically, when prices reach $177, we will sell immediately at whatever the market price is to protect our account. You may ask, what happens if a huge sell order comes in suddenly and flushes the price down drastically? Let's say back to $150. Now, wouldn't we be selling at a much lower and unfavorable price? Remember that stop order is a guaranteed execution but unguaranteed price. So in the case of huge flush down, then unfortunately, yes, we will have to sell at an unfavorable price and we will have to lose more than we intended to. Then you may ask again, why don't we use the stop limit just like how we entered the trade? That way we can guarantee our loss? Well, that is not a really good idea. Let me tell you why. When you add a limit order, your order now have an unguaranteed execution. So if prices flush down to 150 and then temporarily retraces back to the 177, then lucky for you, you'll be able to sell at 177, which is our intended loss. But what if the price flush down to 150 and never rise back up? And from 150, it just continue to go lower and lower and lower. Let's say maybe $120. What will happen then? Alright, in such a case, you will incur even greater loss and you might even blow up your account. And therefore, that is my rationale for using the sell stop order instead of the sell stop limit order for our stop loss. I want to get out at the first available opportunity, since it is a loss already. So lastly, the profit target is an easy one. Once we determine the stop loss, the profit target will just be placed at a price that is 2 times the range of the entry point and the stop loss. You can see that the range between the entry point and the stop loss is $13. And so that is the risk of our trade. And therefore for reward, we will now be asking for double, that is $26. $26 from the entry point will bring us to a price of $206. Profit target is straightforward. We will just be using a limit order. This means that any price above $216, we will sell and take profit. And you can see that this whole trade took about a month to complete. So now that you have learned how to place the order, the next important question is how to determine the prices of this order. This question will be addressed in the risk management video as well as the individual trading strategies videos, as different strategy will have slightly different ways of determining price points. Alright, with that, I would like to take some time to demonstrate how to submit these different orders that we have learned on the Think or Swim platform, which is one of the broker platform that I'm using for my investing. So right now you can see this is the chart for Adobe. And let's say $344, which is the current price, is what we want to buy right now. And how you can enter your order is to right click and then you can see the set of sell and buy orders over here. So we have a buy and a sell, a buy custom, which then leads on to your stop and stop limit, which we have discussed previously, and then sell custom with stop and stop limit. So for trading, we'll be using the buy custom with OCO bracket. And what the OCO bracket does, this will be covered in the individual trading videos. Let's say we are purely buying for investment purposes. And if we click on buy, so you can see this order confirmation dialog appears. And by default, you are buying 100 shares. If there's too much for you, then you can click on edit. And then it will pop up the controls for you to fine tune your orders. So you can change the number of shares here. You can change the buy or sell here. And the price that you like to buy at over here. So let's say we want to buy at $344. And you can see that this is currently a limit order. And we are on the buy side, so this is a buy limit. So under this order, you can then change to the different types of order that we have learned previously. You can change it to either buy market, buy limit, buy stop, stop limit, and for the purpose of think or swim, it has several other more in-depth orders that we can use, but we will not be touching on this. For investing, you'll just be buying and selling using the limit orders. So you can click on limit, and once you have entered the number of shares that you like to invest in, let's say it's 1 shares, and then you can click confirm and send. And here you have your order confirmation dialog again with your cost of the trade and commissions and so on and so forth. All right, so if you want to buy, you just click send and this order will be sent to the broker. With that, we have come to the end of today's video. I understand that this is a condensed and content heavy video. So this is a summary to help you guys in consolidating the info that we have learned today. With that, I hope you have enjoyed what you have learned today, and do show your support by dropping a like and subscribing. Thank you and see you in the next video.